Alright, hello and welcome to Camel Finance. I'm your boy Camel, and today is Thursday, and you know what that means. I've already pointed this out in Monday's video. Thursday, all day, the Jackson Hole Symposium. We also have at 1:30 GMT the initial jobless claims for the US. This will be market moving news for sure. At the same time, we have got the quarter over quarter second estimate GDP readout for the US. So will we get a third negative quarter? If we do, will they say that that still doesn't count as a recession, or will they finally have to concede that we are indeed in a recession? We'll find out. Then, of course, tomorrow, the Jackson Hole Symposium continues at 1:30 GMT. The US consumer spending month over month will come out. This will be market moving for sure as well. Followed by at 3:00 GMT, Fed's Powell is going to give us a speech. So we will find out, are they going to be hawkish? Are they going to just do one more 75 basis point hike and then look to pause next month, as is seemingly being priced in at the moment? I think likely they're going to come out swinging. I think this is his very last chance to be hawkish and to try to maintain some level of credibility following the whole inflation is transitory failure, so on and so forth. I think they've really messed up, and if he just comes out and says, oh, okay, markets, you win, I'm going to be dovish from now on, then he's going to lose all credibility. So I think he has to come out swinging one last time. Maybe he sticks to 75 basis points. Anything 75 or lower, I would think is conducive to a rally. But like I say, I think first of all, especially where we are with the daily cycle count in equities, I think he has to kind of create some sort of pullback, some sort of dip by being hawkish, only to then pivot once we've had the CPI readouts and the FOMC in a couple of weeks' time, mid-September. So overall, I do think we are moving in the right direction for a pivot. Whether it takes slightly longer than I'd anticipated remains to be seen. I do expect a lot of volatility. I do expect a lot of chop. So trade safe out there. And in the meantime, I've got an awful lot to show you, as you can see by the number of tabs. So let's get into that. Sullivan Bank, which has been around since 1895, is now going to let its customers buy Bitcoin. So this is adoption. You cannot stop the innovation. For all of you Ethereans out there, the final upgrade before the merge to proof of stake is scheduled for the 6th of September. So that is right around the corner now. You think you're late to the crypto party? Well, think again. Have you got Bitcoin? Over 320 million crypto owners worldwide. This number has doubled in about a year and a half, so that's really good progress. We should be at 1 billion users in no time, probably by the end of 2024. That's when the maths and the S-curve seem to point to. So we are still incredibly early. MasterCard is working with Binance to enable Bitcoin and crypto payments in 90 million plus stores. This is awesome for the long term, and he's absolutely right. Plan B had an interesting point to make here. In September of 2021, he put this poll out, and you can see that 2/3 of the market thought Bitcoin would go to 100k or beyond. And fast forward to today, and 2/3 of the market thinks that we're going to see 20k or sub 20k again. So they were wrong last time. Is the herd wrong again? Quite possibly. Game of Trade says, let the money printers start once again, as Biden is going to forgive student debt for individuals making under 125k. And Game of Trade says money printers go burr. But I think he's kind of off here, and the Hawaiian has got it nailed. Many people are talking about the inflationary impact or the economic impact of the student loan forgiveness. He says he'll take the opposite view, and in that it will only have an extremely minor economic and inflation impact, because it's only $300 billion. That used to be a lot of money, but we live in a world of trillions now. The impact is political, and it breeds resentment, and I think this is absolutely bang on. This move is entirely about annoying people who have other debts that haven't been forgiven, or annoying people that are either side of the threshold and then don't get to benefit. I really think this is just a troll move, but that remains to be seen. I certainly agree with the Hawaiian in that this is not enough to have severe inflationary impacts, especially when, and I'll show you a bit later, there are much more inflationary forces at work going on behind the scenes. This is not oil, it's not a meme stock, and it's not even a scam. This is the median monthly mortgage payment in America. Look at this. This is the median monthly mortgage payment in America. Again, not GameStop, AMC, not a scam, not a meme coin. This is the electricity prices in Europe. Can you see this? Euros per megawatt hour. Things are getting out of control. We're going to get a bit macro and a bit reset in just a second. The housing market tends to lead the economic and labor market cycles by about 6 to 12 months. Right now, the US housing market is signaling unemployment rate will will likely be above 6% in 2023, which is only about 4 months away now, of course. So you can see here that we have the housing index is leading, okay? This suggests that very shortly we're going to have a spike to north of 6% unemployment in just a few months. So this kind of implies that the GDP readout is going to be negative again. It kind of implies that we are going to enter a pretty severe recession in the not too distant future. Over in Bangladesh, the rising cost of living and power cuts continue for a third day in a row, and they are not happy about it. And who can blame them, frankly? So I seem to show more and more of these clips all the time. The world is seemingly descending into chaos. And at the same time, a nationwide strike and protests in South Africa, again, against rising cost of living, power cuts, mass unemployment, which is now at 34%. So as you can see, this is severe. This is happening all over the world. The reset is seemingly unfolding right before our eyes. I know times are tough, but someone is actually trying to Airbnb a 2011 Toyota Sienna for $100 USD per night. So I respect the hustle. It's not really funny though. I tell you what's definitely not funny, and I do not respect at all, and that is this. If this doesn't look appetizing, you're just not hungry enough. That's from the World Economic Forum. This is from the World Economic Forum. Are you going to eat the bugs? I'm not. I'll tell you that right now. At the same time, we got the French President Macron telling us that this is the end of abundance in this 30-second clip. Check this out.
What we are living through is a time of great upheaval. Firstly, because we are witnessing, and not just since this summer, but over the past few years, the end of what we might have seen as abundance.
The end of what we might have seen as abundance.
And for those who enjoyed it, it is also the end of a carefree time.
The end of a carefree time.
Our freedom, the liberty to which we have grown accustomed to in our lives, has a price, and sometimes when we have to defend it, we have to make certain sacrifices as we fight to defend it.
Sure, whatever you say, Macron. The S&P 500 corporate insider buy and sell ratios show that corporate insiders are still stacking. Timing buys alongside smart money helps. So we've got conflicting signals here, haven't we? On the one hand, the world seems to be falling apart at the seams. The US seems to be descending further and further into recession, although that is subject to seeing the next GDP readout, and of course seeing whether or not it is below the quarter before. We've got a great reset unfolding right before our eyes. But at the same time, the charts and the data is kind of suggesting that we might have already seen the lows. The lows might be in, and that quite possibly, at least historically speaking, entering and building a longer term position right now has historically yielded high returns. So a lot of conflicting data. It all comes down to this Fed, but we have finally arrived here on Thursday, and we will see by tomorrow whether or not we're going to finally get this pivot and whether or not new highs are coming or new lows. Something that made me doubt my thesis that the lows are already in is Jim Cramer. Jim Cramer expects the June market lows to hold and mark the bottom. So this is what I was thinking. As soon as I see Jim saying something like this, it makes me wonder if I know anything at all. This guy is wrong 99.9% of the time on purpose. So is this the 0.1% where he's right? We will see about that. Again, it all kind of comes down to the Fed. Let's keep going. The S&P stocks, the S&P 500 stocks, trading above their 50-day moving average, now surpass 90%. 90% of S&P 500 stocks are above their 50-day moving average. Whenever this has happened before, we've had jaw-dropping returns 6 to 12 months out. So do we get a pullback? Like I said, does the low hold and then do we go to new highs? Well, quite possibly. Something that needs to happen is these yields need to be stemmed. So historical average returns 10 years ahead would suggest that we will have an average of 125% return on investment over the next 10 years. However, with the yields at 3%, which is where we are today, this would only equate to around 50%. So this is not the sort of thing you would want to wait 10 years for, a 50% return. Okay, that's not decent stock market returns at all. The Fed is already not living up to what it's saying. It's already not walking the walk. And you can see that here, as Rudy points out. He says, I know you're doing super hawkish quantitative tightening, letting the securities run off and stuff, but what is this? And then you have a look here. Why did the Fed feel the need to buy $5.7 billion worth of 2-year notes today? Why did they do that? Well, they're doing that because if they don't buy the 2-year notes, this yield is never going to come down. They can't allow this yield to keep going up, and they can't allow the stock market to keep going down. So as you can see, for every point of data that suggests we're going to make new highs and the lows are in, there's also some real sort of unraveling going on behind the scenes. This is a very, very difficult market to navigate. So we really do need to have all eyes on the Fed today and tomorrow. We will see what they say. You can see the yields here. Here we go, right at 3% rate, as I was just showing here. We really need to see this rejected. And again, this all comes down to whether or not the Fed pivots. If the Fed is super hawkish and comes out swinging, I wouldn't be surprised to see these yields run. And I wouldn't be surprised to see the stocks get destroyed. I also, again, wouldn't be surprised to see the dollar take out the new highs if we got a super hawkish Fed. However, any tone of dovishness or anything that's in line with market expectations already, and we will see the dollar roll over, we will see yields come off, and that will be conducive to a risk-on rally. I will breeze through the charts now, but there's really, in my opinion, not a great deal of point in spending much time doing technical analysis, because it basically is all on what the Fed is going to do, isn't it? So again, if we have a dovish pivot from the Fed, dollar will come off, yields will come off, and risk will rally. So that means the stock market will go up. But if we have the Fed coming out swinging, making a last-ditch attempt to be hawkish and claw back some credibility before it's forced to pivot in a month or two, then we will see risk assets come off. You know there's going to be volatility, you know there's going to be chop. I think this is too early to form a cycle low. This would only be roughly day 30-ish. I think that's too early. We need to probably make some kind of bounce and then roll over, or just come down a lot lower. I'd still stand by the fact I don't think the lows are going to be taken out. I think we're going to find a bottom around 3,900, but that remains to be seen. Absolutely same is true for the Nasdaq and for the Dow. I'm publicly long the VIX, so I expect to see some volatility. How far up we go will obviously be correlated to how hawkish the Fed is and how much risk comes off. Real seems to be holding the support here, but I just don't want to be going in, entering big positions into Thursday and Friday with the Fed. I think new positions will be much better to take on the Monday next week. Oil, would love to see it coming for that retest. That would be a long from me. We don't need to see the CPI print and the inflation and the Fed speak again. So again, like I keep saying, there's not a great deal of point in paying attention to the charts at the moment. Gold has, of course, looking to trigger the Heikin-Ashi long out of here. Now, as I've been saying, I wouldn't be surprised to see it undercut this low, and that would be my preferred look. So there's a long trigger above here from the Heikin-Ashi inside bar strategy. If you don't know what that is, go and check yesterday's video. If not, I'm still kind of hoping we get an undercut of that low, but if not, we can take a long on the breakout as well. So plenty of trade ideas for that. But again, want to see what the Fed's saying, want to see what the dollar does first. Same is true for silver. Undercut this low and go would be a great entry. Heikin-Ashi breakout on the silver miners here, as you can see. So that is a long entry as well for an ad. Again, though, want to be proceeding with caution until we know what the Fed is saying. Bitcoin, I could see a pump here. I could see some level of pump, but the 60-day cycle low, which is due on the 11th September, plus or minus 6 days, I think most likely we have to form a low here and then go before we can do anything. I just don't see this coming up and breaking out first. So we will see how this goes. The cycle counts for this and for the equities kind of imply the Fed is going to come out hawkish. So that will give us a drop down into our cycle lows before we can go. There's a definite long from me down here somewhere. Well, I say down here in terms of the timing band, there's a long from me somewhere around this. So plus or minus 6 days of this green line. So stay tuned if you want to see me execute that in real time. The same will be true for Ethereum. This is Bitcoin 60-day cycle low due. So I think that we will likely get a bounce and rejection. I notice we are right into trendline resistance here on Ethereum. So I wouldn't be surprised if we touch that or scam it and then come down and drop into this cycle low. But again, I'm going to be playing patient here because it worked out really well last time. So I'm going to play patient, play the cycle low, and that should be a good swing trade. Can't help but notice XRP wandering towards our target line. So only a week or so away from that. Again, probably has to drop down with the rest of the market into that 60-day cycle low for Bitcoin. But it all comes down to the Fed. So for me, really, I just want to see volatility spike. I think a nice drop into the cycle lows for equities and Bitcoin, that would all make sense. I think the Fed to come out swinging and being hawkish would make sense, as it's its last chance to regain some credibility whilst it still can. I will continue to update every day. So that's it from me. All the best. Take care. Subscribe, hit that like button. I'd appreciate it. Cheers.